I used to see a few traders that I highly respect put up some big numbers in the stock market, and I used to just think to myself, how are they making such a return trading stocks like Apple, SPY, and even Amazon? Because buying 100 shares of SPY right now costs a little more than $40,000, and based on historical data over the past few years, the average daily movement on SPY is anywhere from 0.7% to 1%. So on average, with 100 shares of SPY costing about 40K, you'd make about $400. Not the best return considering how much capital you had to put up for that one trade. Little did I know, they weren't trading shares of stock. They were trading options. And by utilizing options, you could potentially increase your returns while reducing your risk by controlling larger positions with less cost and limiting potential losses. And I had the privilege to learn the mechanics of options by some of the best in the business. So it's only right that I take the information that I learned and pass it down to you. Take out your notes because by the end of the series, your option knowledge is going to go from beginner to advanced. All right, options trading for beginners from the ground up. Take out your notes, take out your pen, take out your notepad, take out the notes on your phone, whatever you need to do. But really take building this foundation really serious because it's going to help you later on when it comes down to finding opportunities, executing on opportunities, and just being creative with yourself and trying new things, trying new ideas. But you can't do that if you don't have a good understanding of what's going on and what you're doing. So I hope you enjoy this options trading for beginners from the ground up. Let's just get right into it. All right, cool. Open a brokerage account. Step one, you got to open a brokerage account. What is a brokerage account? A brokerage account is just where you're going to be able to buy and sell these stocks and options, whatever it is. So research and compare brokerage firms. There's many brokers out there. Research them, see which one's going to be best for you and your needs. I use tastytrade because their platform specializes in options trading. I personally think it's a lot easier to understand the UI, the user interface. So when you're going through the options chain, looking at your positions, I've seen other, platforms before. There's good platforms out there, don't get me wrong, but they can be really confusing and a little intimidating. So I personally use tastytrade, but make sure you do your research and figure out what's going to be best for you. Choose the right type of account for your needs. Individual, joint, retirement, or education. This is going to be one of the questions that's asked when you're, deciding on which brokerage firm you're going to go to. I use individual. Many people use other. There's many accounts you can use, but individual is probably where you're going to lean towards. But make sure you do your research. Now, number 3. Gather the required information and documents, social security number, government issued ID. Don't let this intimidate you. Don't be filling out the information or paperwork and be like, yo, they want my social, they want my ID. It's necessary for this type of business. So don't let that intimidate you, first of all. Now, last one, complete the account application online. You can just go to whatever broker.com or which one you want to use. Put in your information. It doesn't take super long to qualify or be accepted. So make sure you do that, and then you'll be able to set up your own brokerage account. And then a lot of this information that we're going to be diving into, and then when we touch on the platform, when we go in there, show some visuals, it'll make a lot more sense when you have your own broker, your own platform to be going off of. So make sure you do that, do your research, and figure out what's going to be best for you. So that is step one. That's step one. Let's dive into the next slide though. Why options versus stock? Like, why are you even watching this right now when I could just be trading stocks? Why make it complicated? Number one, leverage. Options trading allows you to control a large amount of stock with a relatively small investment, which can magnify your potential returns. So don't let the word leverage scare you. We're not using leverage on margin and whatever idea you might have in your head about leverage. Just know that it takes less money to make the same amount, if not more, with options trading. That's what we're talking about when we're talking about leverage. Now, limited risk. You might think, well, if you leverage position, a more aggressive position, you might, that sounds riskier. It might sound like you might have more exposure with your capital. Well, when buying options, your potential loss is limited to the premium paid for the option. That's when you buy options. We'll clarify later on, which can provide a measure of protection compared to trading stocks outright, right? So when you buy stocks, you want to buy 100 shares of a stock at $100. That's going to cost you around 10 grand. Your max loss on that position is 10 grand. So that's technically risking, or that exposure of capital that is out there, you could lose up to 10 grand. And with options, you can make the same return using a lot less capital to put up front. I'm not saying when you get into a stock position, you're risking the whole, the whole buying power that you use to get into the trade. I'm not saying that, but I'm just saying worst case scenario, if anything were to happen, your risk is limited whenever you're trading some of these options, when you're buying options, and when you're doing defined risk strategies. Again, we'll get into all of that into the video and in more videos to come. If you do have any questions, make sure you drop them down in the comments. If I don't iterate something correctly or paint the picture well enough for you, make sure you drop it down in the comments. I'm open to constructive criticism, and I want to make sure you understand this. So what are options? Options are like insurance for shares of stock. Many investors will buy options to hedge their risk in the case of a big move in the market. Now, I did my own research as if I was someone new just getting into the market, and I watched some of the beginner option videos, and I'm not gonna lie, they kind of confused me. And I've been in options, and I've had the privilege to learn options from guys like Tom Sazop, one of the creators of Thinkorswim, guys like that, Tony, Batista, all of them. So I think the way most people explain options, it can be really confusing when they don't have a really good understanding of options. So they kind of spit out you just the regular definition. And I'm going to go about it a little different in this video. And I would love your feedback on it. But I'm just going to teach you the way that I think it would be best to understand, because again, coming in, it can be a little confusing. But yes, options were used as like insurance to hedge your positions for investors. That's why around earnings time, or whenever there's a lot of uncertainty in the market, investors tend to start buying puts or buying whatever they want to buy so that they can insure the stocks that they have just in case there's a big move. As with insurance, we pay monthly with whatever it is, maybe car insurance. You realize, well, I'm not really getting into car accidents, so it feels like I'm paying insurance for no reason, right? Same thing with a lot of these option buyers. Whenever they're buying options on their long-term investments, sometimes they didn't even need the option because they didn't need to use that insurance in case of an emergency or whatever the case is. So a lot of those option contracts will usually then expire worthless, which creates an opportunity if you sell options. Again, we'll get more into that into the next videos and more in depth into this video as well. But what are options? You can use them like insurance. Just get that on this slide. Options are used like insurance, but in this video series, we're primarily going to focus on trading the price fluctuations of the option contracts and what affects their price, right? Yes, when you type into Google, what are options, it's going to give you a different definition. And if you're new, I guarantee it's going to confuse you. But if you're new, just understand this. We're going to be trading the price fluctuations of the option contracts themselves, and we're going to study and understand what affects their price. And we're going to get into that into this video. But understand that with stocks, we're trading the price fluctuation. If Apple is at $100, we buy at $100, and Apple moves up to 110, we sell at 110, we make a $10 profit, a 10% gain on that $100 investment, right? Here, just because Apple goes up $10, goes down $10, doesn't mean you're going to make or lose money. There's more to it than that, because it's not only the stock price that affects the option pricing. We're going to get into that into these next videos, but understand that we're trading the price fluctuations of these options contracts. You might have to really open up your mind a little bit when we're talking about these new abstract concepts, because it can be a little confusing. And by you taking what you previously learned, it might hinder you a little bit when you're trying to understand some of the things I'm trying to pass down to you right now. So how to trade options. Options allow you to choose what price level you think a stock will go to or not go to within a specific time frame of your choosing. So I didn't highlight price level and specific time frame for no reason. That's not the actual term that we call it. That price level that we have up there is called the strike price. Every option contract has a strike price. When you're selecting an options contract, you need to select the strike price, right? And then that specific time frame is called the expiration date, right? So you have to choose your expiration date, and then you need to choose your strike price. So these are two things you need to know what to choose. And a lot of people are like, how do you know which expiration date to choose? How do you know which strike price to choose? And again, as we get more into this video and into the next videos, you'll have a complete understanding of all of that. But just take this with a grain of salt from now. Price level equals a strike price. Specific time frame is the expiration date. So example, we'll go over here to our platform. We'll give a live example. Let's use SPY since we have SPY pulled up. I know you're jealous of my blue background. I've had a couple haters, say they're not vibing with the blue background, but the blue background is just a lot more appealing. And I feel like you can see, I am slightly colorblind, so I feel like you can see the red and the green candles a little bit better with that contrast, but the blue looks dope. If you don't believe me, change your background to blue and let me know what you think. It doesn't do it justice on the screen. You got to see it on your own screen. Anyways, let's use SPY for example. Let's go over here to our trade page. So there's a tab on the left right here. I don't know what platform you're using, but I'm using Tasty Trade. When I come over here and click on my trade tab, let me clear this out. If I come over here and click on my trade tab, this is going to bring up something called the options chain. And this is where we can find our expiration date. And this is where we can find our strike price, right? So the options chain is first going to pop up and you're going to see a bunch of different dates. And this is called our expiration dates. Now, when you choose an expiration date, we'll get into how to choose one. But when you do choose one, you'll notice there's a lot of random numbers. But notice this column right down the middle. And you'll see at the top, it says strike. These are the strike prices. You may not understand a lot of this yet. You may not understand how to choose the correct expiration, how to choose the correct strike price, any of that. It's okay. I'm just taking you from the ground up and showing you what tools you need to be looking at and how to even navigate the options chain and what these things are, right? So that's the expiration date and that is the strike price. Let's jump right back over to our slides and not get too much off track. Now, all options include these two things: a price level, which is a strike price, and the specific time frame, which is the expiration date. We just went over that. Now, there's a price attached to all these options, and that price is what we call premium. Okay, so when we choose that specific expiration date and that specific strike price, there's going to be a value whenever we choose whatever contract or strategy that we want to do. That is called the premium. When you're choosing an option contract, you have to choose a price level, you have to choose the expiration date. And that comes with the price tag, and that price tag is called premium. The premium of an option is what the contract is currently worth. There are three things that influence the value of an option. I'm going to give you 5 seconds to get at least one out of the three. I feel like one of them is pretty obvious, and I could understand if you didn't know the other three. But I'm going to give you 3 more seconds. This is like 10 seconds total. All right, I'm giving you some cheat time. Anyways, time's up. You can pause the video. I'm just going to let you know I'm going to the next one. Stock price. If you got stock price, that one was a little more obvious maybe. Volatility and time. You might be like, yo, Errol, I know what the stock price is. Cool. What is volatility? What is time? Does time have something to do with the expiration date you just showed us? Is this? Yeah, a little bit actually. But hey, don't let that confuse you. Just understand right now, there are 3 things that influence the value of an option. I want these in your notes because when I come back to these other videos, you're going to be confused about something. You want to be able to refer back to your notes or this video. Make sure you bookmark it right now. Like the video if you enjoy these type of style videos, and we'll keep doing more educational tutorial videos like this. But write this down in your notes. If you're a beginner, this is something you're going to need to ingrain in your mind, because understanding these fundamental points helps you spot opportunity, helps you manage your position a little bit better because you have an understanding of the fundamentals: stock price, volatility, time. Understand those 3 things, and those 3 things influence the value of an option, not just the stock price. Now, we just talked about what creates the value of an option contract, and that is called the premium, right? So how does this premium fluctuate in price? One thing you need to know about option contracts is the fact that as the option contract gets closer to its expiration date, the options lose value. So let's go into these platforms. We're on SPY. Let's click on May 9th. No, let's click on June 16th, 33 days till expiration. And let's just click on the at the money call. We'll click on the at the money call. That is going to be $792. That's going to be $792 for that call. I know it's a little expensive. We're out in a further date and we're doing an undefined risk strategy. We'll go over all that in another video. But that is going to cost me $792. Let's say, for whatever reason, SPY stayed at 411.59. Let's say it stayed at 411 for the next 30 days. For the next 30 days, this contract is going to be worth way less than $792. Why? I'm going to give you 5 more seconds to tell me why this option contract is going to be worth less in 30 days, even if the stock price doesn't move. What changed? The stock price didn't change, but we just understood that the stock price isn't the only thing that changes the prices of options. What else do we have? We have time and volatility. Okay, let's break that down now. Volatility didn't change, or volatility might have not changed because, let's just say the stock price stayed the same. There was no, volatility really in the market to be priced in. So it's got to be time. As we can say, we fast forwarded 30 days. I know it's a little obvious. Time was the thing that affected this option price. But I just really wanted to show that example so you understand how the stock price really is not the only thing that will affect the options price, and time will decrease the value of all options as they get closer to its expiration date. Understanding these fundamental things will help you be really creative, try new things, kind of trying things outside of the box, trying things that you were taught, and maybe going outside of the box from what you were taught a little bit just to test the waters and see what you like and all that kind of stuff. But if you won't be able to get to that point until you understand these base level fundamentals. So understand that. I know all this information can be a little overwhelming, so take some time to let it all soak in and make sure you rewind parts of the video if you need to. Because next video, we're gonna take it a step further and it's gonna build off of the information that was presented in this video. And if you do wanna follow along with me, the platform that I use will be the first link down in the description. And if you wanna join a free community with more option resources, that will be the second link down in the description. And last, if you don't wanna miss the next tutorial video, be sure to subscribe to the channel, turn on post notifications, and I'll see you in the next one.